I've spent the last 20 years of my life investing in the stock market, and for most of the time, I thought success came down to picking the right stocks and timing my buys and sells. But it turns out I was wrong, and in fact, this has probably cost me hundreds of thousands of dollars in lost gains. The truth is, there's a lot of hidden math at work that is quietly destroying most people's retirement accounts without them even realizing it. And the impact of this for high net worth individuals is even more extreme. So today, I'm going to reveal exactly what this hidden math is and how you can use it to work for you, not against you. First factor that determines success in investing, as we all know, is time. We hear about this all the time, but people still forget how long it really takes to build wealth. The length of time you stay invested matters far more than trying to time the perfect entry or exit. This is because of something Einstein himself reportedly called the eighth wonder of the world: compounding. Compounding is when your money makes money, and then that new money makes even more money. Let's take a look at two investors. Anna invests $2,000 per year beginning at age 30 and then stops investing after 10 years. So her total contribution is $20,000. If she makes no further contributions and stays invested for 25 years, the value of her account will be $128,511. Bill, on the other hand, procrastinates and doesn't start investing until age 40, and he contributes $2,000 per year for a total of 25 years. So his total contribution is $50,000, and at the end of that 25 years, he'll have $118,313. So as you can see, starting early is far more important than how much you even invest. Now, if you had a crystal ball and could pick the right stocks at the right time, maybe you could do better, but that's just the problem. Timing is impossible. You might be thinking, what if I just try to time the market, sell when values are high and buy back when prices drop? Could you increase your returns? Well, technically yes, but in reality, timing the market is nearly impossible, and you will almost definitely lose in the long run. In fact, a recent JP Morgan study found that missing just the 10 best trading days over a 20-year period could cut your returns in half. For some, that's the difference between retiring like royalty or barely making ends meet. But why is this? Well, the study found that over 20 years invested in the S&P, the best days often followed the worst days, and capturing the growth on these best days had the greatest impact on overall returns. And of course, you'd only capture those high growth days if you're already invested. If you wait for that spike and try to jump back in, it'll be too late. So buying and selling could cost you more than just fees. It could cost you opportunity for significant returns. The truth about investing isn't complicated or exciting. It's about patience, consistency, and understanding the real math behind your money. But there's another secret that is much spoken about, and it can destroy your returns, and that is fees. Even a 1% difference in management fees can cost you hundreds of thousands in the long run. Fees reduce your returns in two ways. First is a direct deduction from your returns. Just like compounding increases your returns, it can also amplify the impact of fees. For instance, a 1% fee on $100,000 is $1,000, which might not sound too bad, but that same 1% fee on $1 million is $10,000. So essentially, you're paying a lot more for the same advice. But by far, the biggest sting from fees comes from a loss of compounding. A $1,000 fee today could cost you tens of thousands of dollars 30 years from now. The fees not only take away from your initial investment, but also from the potential future earnings those funds could have generated through compounding. Compounding growth over 30 years at 6% on $10,000 versus $1,000 is very different. And keep in mind, some of these fees are not a one-time cost. They are an ongoing expense for the life of your investment. Some common fees are expense ratios charged for maintenance of the fund, advisory fees charged for managing your investments, account maintenance fees, load fees charged to buy or sell shares. And here's something counterintuitive. You don't need to pay for expert advice. Index funds beat most professional money managers year after year, and they can be as low as 0.07% for the Vanguard S&P 500, for example. Reducing your costs is important because even small fees taken off compounding growth adds up to hundreds of thousands of dollars over time. And when you consider the next factor, this cost will become even more important, and that is inflation. A 7% return sounds great until you realize inflation was 4%, and suddenly your real purchasing power only increased by 3%. This is why you need to focus on inflation-adjusted or real returns, not nominal ones. Inflation is the rise in prices of goods or services over time. When economists talk about inflation, they are usually referring to the rise in consumer price index, which tracks overall prices of goods and services at the retail level. The inflation rates vary, and it's impossible to predict future inflation, but experts use 3 to 4% as an average inflation rate when making their calculations. So you can see how a 3% inflation and 1% fee can quickly cut your returns in half. Inflation affects different asset classes differently. For instance, instance, a fixed income asset such as a bond or CD loses significant value in times of inflation. A bond pays a fixed rate of return. If that rate of return is 4% and inflation is at 5%, your real return is negative 1%. So even if you're earning the nominal return promised, your actual return or purchasing power of that money is reduced. Furthermore, the value of the note or bond in the market is reduced. Since there will be new bonds issued at a higher interest rate, the existing bonds will be less valuable. Inflation affects stock prices less, however, it still trickles down to your returns. As prices for goods and services rise, companies will pass on those costs to consumers. So revenues and profits may increase with inflation. However, high inflation may increase production costs and decrease market demand, and that will in turn decrease profits. So how does your return actually look when accounting for inflation? Let's take a look at the data set composed by Robert Shiller, economist and Nobel Prize winner. This data set converts the monthly stock prices to real values by accounting for inflation. This first graph shows the nominal price of US stocks. This next graph shows the rate of growth after adjusting for inflation. And this graph is taken from the Investor's Manifesto by William Bernstein. As we can see, the actual or inflation-adjusted returns are much more modest. Alternative assets such as real estate can sometimes provide protection against inflation. This is because revenue is generated from rental income. As inflation rises, rent increases are passed on to tenants. However, depending on the market, there may be a cap to how much rents can rise, and being overly aggressive can cause your occupancy to decrease, and that will decrease overall returns. But many times real estate is a good option to provide that hedge against inflation. So if you're interested in learning more about how real estate syndications work, make sure to download my free ebook below. The bottom line is that inflation and interest rates have a significant impact on all investments, and the key is to diversify just enough, because as we'll see in the next lesson, even diversification has its pros and cons. The goal of diversification is primarily risk reduction, not maximizing returns. By investing in various companies across different sectors, industries, or even countries, the risk from any one market or industry is decreased. That said, it's important to remember that no matter how diversified your portfolio is, your risk can never be eliminated. You can reduce the risk associated with individual stocks, what academics call unsystemic risk, but there are inherent market risks, systemic risks, that affect nearly every stock, and no amount of diversification can prevent that. Edwin Eldon and Martin Gruber's book Modern Portfolio Theory and Investment Analysis stated that you can only reduce your risk so far. In fact, they suggest diversifying across 20 stocks and no more, because beyond that, the risk profile is not that much more improved. So what are the downsides to over-diversification? Well, first of all, it limits potential for extreme gains and dilutes your returns. A highly diversified portfolio, while protecting against large losses from any single investment, also reduces the possibility of realizing exceptionally high returns from a single high-performing asset. And much of the gains from a high-performing asset will be offset by moderate gains or even losses from others. And then you have increased transaction costs and management. Diversifying across numerous assets may involve frequent buying and selling, leading to higher transaction fees, commissions, and potentially higher taxes on capital gains. With all this maneuvering, we're all after those gains. But here's where it really gets tricky. The average returns you see advertised are not what you actually get. There's a thing called volatility drag. The market doesn't move in straight lines. Stocks are volatile, meaning they change in value a lot. This fluctuation can have a significant impact on your overall return. When you lose 50%, you need 100% gain just to break even. That's why consistency beats occasional home runs. Let's use some real numbers and look at this example from Smart Asset. Your portfolio value at the beginning of the first year is $100,000. After gaining 60%, the portfolio value ends the first year at $160,000. After a 40% loss, by the end of the second year, the value drops to $96,000 for a 4% overall loss. This means that a volatile investment, even with a seemingly good average return, can actually grow less than a more stable one with the same average return. Let's take another look at this concept in this model provided by Return Stacked. This hypothetical stock varies from +2 to -2 every day. The average daily return is 0%, but the daily compounded growth is -0.4%. Despite having an average daily return of 0, the value of this hypothetical stock would go to 0 over time. All of these factors are affecting your returns, and it's important to be aware so you can adjust your strategy and manage your expectations. I hope that was helpful. Remember to like and subscribe, and I'll see you next time.